Alibaba is down a grand total of 11.6% post-earnings. I know emotions are all over the place, and it's particularly amplified on many of these social media platforms. Discussions on both sides of the aisle, regardless whether you are from the bull camp or the bear camp, they tend to get a little bit aggressive. So I just wanted to start off this video with this very interesting meme that I saw online. Let's try to at least take an objective look at their most recent earnings report and then make the assessment of whether this warrants such a big drop or not. I'll briefly run you through their most recent quarterly results, both the presentation deck and also the slides, the PDF. More importantly, I think this time around, because of this new leadership transition, the transcript was particularly important, and it basically shows you the character and, more importantly, the different leadership style from the different key position holders. And last but not least, of course, looking at Alibaba's valuation today. And of course, remember to smash the cute little like button before you forget. On a top line basis, their consolidated revenue, Alibaba actually grew 9% year on year, and they did provide a segmental breakdown of the different individual business arms. Personally, to me, Taobao and Tmall Group is the bread and butter because it's the e-commerce platform, it's the advertising revenue. These two basically derive the entire bottom line of Alibaba. But also, of course, we cannot forget that some investors are also betting on many of these other side core options and side businesses of Alibaba, like cloud, like Cainiao, like their international commerce group. So we will take a deeper dive into them later on. On the bottom line, at least, you can see that even earnings per share, they are recovering healthily. Adjusted EBITDA, they are recovering healthily. So they're generally in the right direction. On the cost of revenue basis, I think Chinese tech companies have been slightly late to the game, but saving costs is the name of the game. You can see overall, their cost structure is pretty tightly managed. So cost of revenue as a percentage of the revenue, they are down 100 basis points, 1%. Product development expense stayed flat. Sales and marketing stayed flat. General admin expenses is also down 1%. So you can see that the management team is indeed putting in the effort to keep their cost structure tight. Income from operations, they're up 34% year on year. And more importantly, you can see that in terms of share-based compensation, they have been holding back in trying to reward employees handsomely and just frivolously. Moving on to the cash flow side of things, you can see that net cash provided by operating expenses, it's up very nicely, and because of the significant reduction in capital expenditure, it's more than half. That's why free cash flow ballooned to 6.2 billion in USD in this quarter alone. And of course, one of the most key segments of Alibaba's investment thesis, it's their financial fortress. They have so much assets on their balance sheet today. Cash and cash equivalent, 33.4 billion. Short-term investments, 40.6 billion. Other treasury investments, 11.5 billion. So their cash balance works out to be around 85.6 billion freaking US dollars. Not to forget, their current market cap is around $200 billion. So they have around 40% of their market cap in cash alone. But let's not forget, on their balance sheet, on the other side of the ledger, they also have some short-term liabilities. So if you net it out, I believe it's closer to $26 billion. So net, they actually do still have $60 billion in cash, which is 30% of their market cap. So for Taobao and Tmall, they achieved the healthy year-over-year organic growth of Taobao app users as a result of their content and price competitive strategy. And more importantly, they did give some sort of guidance where Taobao and Tmall successfully concluded their 11/11 festival, which recorded positive year-on-year growth in participating merchants, transacting buyers, and order volume growth compared to the same period last year. I think this is particularly important because the same period last year, when they had their 11/11 event as well, I think the turn-up rate was lackluster and growth was actually stagnant. I believe it was slightly negative. They reported some sort of a flattish growth. So this time round, we can see that the consumer sentiments are coming back again, and Alibaba, by extension, the largest commerce platform, is going to benefit from this trend moving forward. And I think one shining star that people tend to forget about many of these massive advertising platform is really their back-end infrastructure, and they actually floated some sort of visibility on this as well. So they said, Taobao and Tmall continues to expand AI products and services for its merchant operation platform and monetization platform. So it now offers AI tools that simplify and automate online store operations, such as new store design, product photo and description generation, customer service, and financial and order management, all of which improves merchants' operating efficiency. I believe particularly so for big advertising platforms like Meta, like Google. Many of these advertising infrastructure is critical, and it forms as a moat to many of these competing advertisers in the entire marketplace itself. So for customer management revenue, they actually increased by 3% year on year, primarily due to the increase in merchants' willingness to invest in advertising. And it's partly offset by the modest decline in online GMV generated by Taobao and Tmall. A modest decline in online GMV means that the competitiveness in the entire commerce space back in China is slowly eating into Taobao and Tmall's market share. So I guess this has been an ongoing trend moving into the entire live streaming, which they have constantly been talking about trying to enhance the content strategy, getting more influencers online, and trying to build out the entire ecosystem. But they have been very slow, and this requires much more closer monitoring in a few quarters to come. So direct sales and other revenues, an increase of 6% year on year, primarily due to the strong sales driven by consumer electronics and appliances. So this is a similar trend even for JD.com as well. We can see that consumers are slowly opening up their consumption funnel. So for the commerce wholesale, they actually increased 18%, primarily due to the increase in revenue from value-added services provided to paying members. And this is a healthy trend because this is similar to Amazon Prime, and they are currently adding more and more users into their subscription service. So revenue from international commerce retail business actually experienced an increase of 73%. This revenue increase was primarily due to the strong combined order growth of their international retail business, driven by solid performance of all major retail platforms, and the revenue contribution from AliExpress Choice, a new model launch, and an improvement in monetization. So Choice is actually a new model which works closely with Cainiao to improve customer experience. So you can see that it's actually a common theme amongst the commerce experience, regardless whether you're in America, whether you're in China. People want cheap, people want good, people want fast. And once you build out many of your back-end infrastructure, whether is it your advertising front for the ease of advertisers to enjoy greater conversion, or you build out your delivery network so that consumers have a greater shopping experience, all these are going to add into the flywheel of the entire e-commerce activity and experience of the platform itself. And also, Lazada actually recorded double-digit order growth rate year on year, and they focus on improving monetization. So losses per order actually not narrowed quarter on quarter and year on year. So for Cainiao specifically, they didn't talk much. They basically just throw in all your popular terms again. They leverage on technology to remain competitive, and they started providing parcel bundling and direct shipping capabilities through data analytics and algorithm, blah, blah, blah. But you can see that it flows through into the top line. There's a 25% year-on-year growth rate, and I believe that the revenue derived from the logistics business of Alibaba can rival that of JD.com. So it's on a very nice trajectory. So you can see that local services group, even though they're growing nicely, but they're still not contributing meaningfully to the bottom line. I think this is where the greatest disappointment came for most investors. Not only are they growing slowly, the entire IPO for this cloud segment essentially got rug pulled. So I think generally, in terms of business highlights, they talk about the generative AI model, their 同义千文, their large language model, and their ecosystem of how they are being the largest open source developer community. I think all these are good. All these are qualitative analysis, but I think 2 years back when Daniel Zhang was still the CEO, he was banging onto the table talking about how big the addressable market is, how big the size of the market is, and how Alibaba or AliCloud specifically is able to take advantage of that tailwind. You can see that the growth instead is congregated to many of the public cloud platforms rather than many of these tech companies like Tencent Cloud, Baidu Cloud, or even AliCloud. So top line year-on-year growth, it's at 2%. It is lackluster, definitely, if you're talking about how big this total addressable market is. And when comparing it to their other US tech counterparts, 2% would not cut it out. I do still believe that many of these tech companies, tech platforms, namely these big tech customers, are undergoing this transition phase. That's why the revenue growth is stagnant and hasn't been performing very well. So truth be told, I don't have better insights into this, and the only thing we can do is just wait. But more importantly, at least if you want to form your investment thesis around Alibaba today, it should still be around their cash generative ability, how they're able to benefit shareholders and generate shareholder return through their balance sheet, through their share buybacks, and through their core capabilities in e-commerce and advertising. So moving ahead into the disclosure, I always like to start out by reading what the CEO has to say. So Alibaba Group delivered a solid quarter marked by renewed momentum and energy across multiple business as a result of our strategic reorganization. So as we embark a new phase of development, we have clearly defined our strategic focus and priorities. So we will maintain an entrepreneurial mindset. So we are committed to investing for growth and making bold decisions when necessary. Through a more flexible organizational structure and governance mechanism, we aim to capture brand new opportunities from the ongoing AI tech transformation and create more value for our customers. So like many of the other tech companies and even Tencent specifically, a lot of them are just biting on this AI word. So I think I just wanted to put a footnote here. Try to explain a little bit more in terms of this entrepreneurial mindset and having a flexible organizational governance mechanism. So back then, when Alibaba was managed as one group, I would presume that there was a lot of bureaucracy, how individual departments have a lot of challenge in trying to overcome competition. So right now, when they decentralize this decision-making process, yes, it allows them for more nimble movement, but I dare say that it's gonna be a lot messier. And that has been the ground feedback from what I've observed from employees, ex-employees. They're saying that it's getting very, very messy. But let's also not forget, Alibaba managed to climb to the top in e-commerce is because of their competitiveness. And if you want to be competitive, it will get messy. So I think there's just some nuances that you have to get comfortable with. So the United States has further restricted the export to China of advanced computing chip and semiconductor manufacturing equipment. So we believe that these new restrictions may materially and adversely affect Cloud Intelligence Group's ability to offer products and services and to perform under existing contracts, thereby negatively affecting our results of operations and financial conditions. So after consideration, they have decided to not proceed with a full spin-off, and instead they will focus on developing a sustainable growth model. And specifically for the international commerce arm, they are preparing for external fundraising, and for Cainiao, they have already applied for an IPO in Hong Kong and have submitted the A1 filing to the Hong Kong Exchange. So for Freshrepo, they're going to delay the IPO as they evaluate market conditions for a better transaction value. Last but not least, in terms of returning money to shareholders, they've repurchased approximately 18.6 million ADRs for US $1.7 billion, and they have roughly around $14.6 billion left in their share buyback program. More importantly, there's a new addition to the dividends where they said that they're going to give out around $1 per ADR, and that's approximately $2.5 billion US dollars because they have 2.5 billion outstanding ADR per share. So some people, especially in the investing community, have said that Alibaba, that's so stupid. Why are you guys doing it? Let's not forget that there's a 30% withholding tax in the US exchange, and because your share is so undervalued, you should be buying back shares rather than giving out dividends. So personally, to me at least, I largely agree with the larger investment community. I very much prefer a share buyback rather than a dividend yield. But that said, I think sitting on this entire idea of having dividends and discussing with a few friends and looking at some of the forums, I must say that having a dividend policy have some sort of other innate benefits as well. So let's not talk about it on a theoretical sense. We do know that if Alibaba has $2.5 billion on the balance sheet, the market value should be increased by $2.5 billion. And once they issue out this dividend, the share price should react accordingly. But let's observe it from an intangible perspective. So a dividend yield probably stabilizes the share price much more, better than buybacks, on two counts. Number one, it provides more visibility to ending shareholder that they see this X amount of dollar coming to their bank account. For many people, don't ask me why, they feel much more safer and much more secure when they see the dollar amount come into their bank account or come into their brokerage account. And secondly, it actually signals much more alignment in trying to create shareholders value, because let's not forget, in terms of the buyback programs, tech company on one hand is buying back shares, but on the other hand, they are issuing out shares through share-based compensation. So net-net, does it really create more shareholders value? I think this is debatable from company to company. However, having a dividend policy, that basically explicitly signals to investors that, hey, I'm taking care of your interests, I'm giving you money. So these are all the intangible benefits of a dividend policy. I'm not saying that this is the best way to allocate capital, but it has resulted to the extent that regardless of how much Alibaba say that they're going to buy back shares, it's not enough to move the share price, and the shares continue to plummet. Now, moving on to the transcript, I'm going to focus much more in terms of the analyst questions, but I would like to encourage all existing and even potential shareholders to read through the transcript religiously. You can really see in terms of the different leadership style and their focus in this key leadership position. So first and foremost, Zhou Cai, who's the chairman of Alibaba Group, you can tell that he's from an investment banking background. Zhou Cai really knows what investors want to hear. He started off by saying, oh, we'll use our resources to ensure long-term strategic synergies. All your buzzwords that people like to hear. And more importantly, one of the key factors that most investors like to look at, which is ROIC, and he outrightly just dropped it into the earnings call and in his opening remarks. Our ROIC was in the single digits. Obviously, there's room for improvement, and we are targeting to lift our ROIC into the double digits. Number two, they want to invest the cash flow for future growth. So they are looking at creative ways to monetize the value of these assets. So they are also focusing on returning value to shareholders via share repurchase and distribution via dividend. So he's basically a Wall Street guy, and he knows what you guys are looking for. So moving on to Eddie Wu, since he's the CEO of the group, I can tell that he's trying very hard to be that visionary. He's trying to paint the vision and paint the future of Alibaba. That's why he keeps talking about technology-driven internet platform, AI-driven business, and global commerce network. And he continued on. I think his opening remarks is extremely lengthy. And not only that, they've actually allowed the individual CEOs of the different business segments to have an opening remark. So you can see that this is the new direction that they're heading. Individual business CEOs or business segments, they will be accountable for their own business units. So Trudy Dai, who's one of the important people that I follow as well, because she's the CEO of Taobao and Tmall, she did iterate that they continue to achieve rapid growth in DAU, which is daily active users. And more importantly, they did see organic user growth in the same time. And one important frontier in the e-commerce ecosystem is live streaming. Taobao's live streaming ecosystem maintained its growth momentum. And also the vision statement of Taobao. There's no question that the Taobao app has everything that you could want or need. The only question is, can you think of everything you need? So on the part of the backend advertising infrastructure, Trudy said that there's a major upgrade to Alibaba's Wanxiangtai product. So it enables merchants to allocate their advertising budgets across all available properties within the Alibaba ecosystem using a single interface and leverages AI to provide data analytics and insights to intelligently locate targeted users and to create AI-generated advertising content. And I do believe that this is going to be a game changer moving forward, and I'm keeping my eyes peeled on how they are going to continue expanding and continue building on the good works of Alimama, which is their advertising platform. So from Goldman Sachs, they are basically asking about the ongoing reorganization of AliCloud and the plans moving forward. More importantly, did Alibaba consider further upsizing the buyback or even a special dividend, considering a 63 billion net cash position? So I think in terms of cloud growth, Joe or many of this management team do not have any visibility, and they really can't make a promise. So there's a lot of fluff here. But there's one thing for sure, they are currently not considering a one-time cash dividend, and they said that they're going to lay out their priority for cash use to invest for future growth. So from Citibank, they are talking about the investments that yielded results and whether they exceeded their expectations, and also the experience of users coming from WeChat as compared to other channels. So Trudy did give a very simple explanation that the collaboration with WeChat has been focused on a few limited areas, one of which is traffic, and the influence has been very limited. So let's not get our hopes up of Alibaba working with Tencent or vice versa. So from Morgan Stanley, Gary is basically asking how they are intending to increase their return on invested capital. And when I read what Trudy said, I was basically not convinced. I don't really think she knows what's going on. She doesn't have the big picture. Actually, I think Zhou Cai or even Eddie Wu would be in a better position to explain. So she said that the growth and future profitability will help certainly generate more earnings, which will contribute to increase of return on invested capital. Nothing tangible, nothing concrete. So Alex Yao from JP Morgan basically asking whether the IPO of AliCloud is temporary or is it a permanent decision. So Joe was very frank about it. He said that when they announced the full spin-off, it is some sort of a financial engineering way to show the value of the business. But I think after the new crackdown on US exports, they said that it became increasingly unpredictable with their ability to project the business and communicate to investors, to provide a level of transparency to independently hold the shares of Cloud Intelligence Group. So it's better to subsume it under the group so that they have greater autonomy to move it. And from Eddie's perspective, they still have the commitment to support a very strong architecture, which is heterogeneous in nature. All these are just big words at different levels. So I think if you have to triangulate what management has to say, the underlying core philosophy of Alibaba is very simple. What Taobao wants to do is to be the one-stop shop. They are able to handle any queries. They are able to offer up any products, any services that you want. They're just afraid that you cannot think of it. Similarly, for cloud, their commitment is to be the one-stop solution. So any technology that you can think of as a consumer or provider, Alibaba is here to deliver. So this has always been the underlying philosophy of the entire business itself. So I think just to answer a few other core questions that was floated during this earnings. So Ma Yun's family trust fund is disposing of 10 million shares. That works out to be around $870 million. And it has been reported the comments from Jack Ma's own office saying that they're still very positive about the company and that the phase sale is part of a long-standing preset conditional plan to do a partial sell down for the future. I think I really wouldn't blame Jack Ma for trying to cash out on his position. And this is really not the first time that he's cashed out. He has been selling slowly but surely. I think initially he had around a 6.7% exposure to Alibaba, and right now he's sitting closer to 3%. After this sell down, it's under 3%. So that's why he has already been a net seller. A lot of all this story building is just to create and craft a certain narrative, not really substantial and not very important. And more importantly, let's focus on the current valuations of Alibaba today. So Alibaba now has around 74 billion in cash, or 33% of market cap. If we net it off, they have closer to $60 billion in cash, which makes up of around 30% in market cap. They're trading at a free cash flow yield of around 13.5% and pays a dividend of 1.25%. Post falling in the market itself without stopping the buyback. So this is a very simple DCF of Alibaba based on the past 6 years track record. So at the peak free cash flow period, they are generating around $190 billion in RMB of free cash flow. So moving forward, the projections is very simple. I think they're on track to deliver $220 billion from cash from operations, and their capex, let's just round it up to $40 billion. So that brings their free cash flow to around 180 billion RMB. This is actually a haircut from their peak free cash flow period. And on top of that, let me try to paint the picture of what the market is trying to value today. So let's assume that their cash flow from operations is going to flatline, 0% growth rate out into 2026. Their capex is going to continue ballooning because they have to upkeep their infrastructure at 5% year on year. And you can see that free cash flow is actually decreasing because top line stays flat, cash from operations is flat, while capex is increasing, and applying a free cash flow terminal multiple of 12 times, which means that the free cash flow yield of around 8% and a weighted average cost of capital, which is the discounting rate at 15%, use an exchange rate of 0.14, at a share price of $76 today, they're still undervalued with a price target of around $134 with an upside of 76%. So if you wanted to do a reverse DCF to see what the market is trying to price in today, using the same assumption, what I can do is change the terminal free cash flow multiple to 5 times. So meaning they'll be trading at a free cash flow yield of 20% with a discounting of 15%, and that's where the $76 is at fair value territory. And just understand how crazy the valuations of Alibaba. So I don't know what you think of Alibaba as an investment opportunity today, but I see a great deal ahead of me. With that, I'll see you in the next video, but more importantly, I'll finally see you on the moon. Goodbye.